What's up, everyone? Welcome back to the Commission Keeper Podcast. I am your host, Cameron Hodge, tax preparer and licensed agent as well in California and Florida. And on this show, we talk about everything I possibly can find and what I know when it comes to post-commission income, what to do with it, how to use it for your benefit, and everything in between. All right? Now, this episode, look, I'm going to keep it short and sweet, okay? But it's going to be about being the agent that understands taxes. Not to the point of becoming a CPA, an accountant, tax preparer, enrolled agent. No. I'm not talking about you guys becoming the top tax professional in your field, right? Because you go do taxes like I do, all right? But there is a purpose. As agents, every single day we run into situations where, hey, you know what? Our clients need guidance. They need the ability to have at least a general idea of what their decisions are going to cause. Okay? Because the reality is most Americans do not think about tax time. Let's be honest. As agents, we do the same thing. But many of us don't realize or think about taxes and the decisions we make throughout the year until we're going to do taxes at the end of the year. Right? And the reality is when you're going to a tax professional like myself, all right, and you're bringing paperwork, there is no saving taxes, friends, okay? All you're doing is complying with the law. That's all you're doing. Tax savings come into play before you meet with your tax professional. Or, obviously, for many business owners, it's a lot different because you are reaching out to your tax person throughout the year, just like I have clients who will reach out to me depending on their situation, once, twice, every quarter. We're meeting, we're discussing how their quarter went and how their taxes can be changed, their strategy, such and so forth. But as agents, having a basic idea, and I'm just going to cover some basic real estate knowledge when it comes to taxes that can benefit your clients. This does not mean this fits every client you have. The reality is I don't expect you to know if certain, exclusions or benefits help your clients, but at least you have a general idea of, the situation might need some counseling from someone who understands taxes before we jump into it, especially when it comes to investors. Look, as agents, we always meet those people that are buying their first rental property. Look, we really have to have a basic knowledge and then also have the connections of the professionals that they can reach out to, okay? So the first one we're going to talk about is the home sale exclusion, okay? Kind of like a tax-free profit rule, right? It's not really tax-free, right? There's no such thing as tax-free, but it's a fun little way to go about it. It's really just using what the government has in place to not have to give up income when you sell a home, all right? So when someone sells their primary residence, again, not a second home, not an investment property, we're talking about their primary residence, they have, as a single individual, up to $250,000 of equity or $500,000 if they file jointly every year of gain from that sale that can be excluded from taxes if they live there for at least 2 of the last 5 years, which most of our clients are going to benefit from this, okay? So this is the general one that usually applies. Also, which is why most tax professionals do the right job when it comes to tax time. Okay, this is pretty obvious. But that's also why as agents, on top of that, when we talk about this, you should, when you get the, how we all upload to our different databases and portals to be compliant when we sell a home, you need to make sure you keep a copy of that settlement statement. Okay, now your state may call it something different, but that final statement for what your seller netted at the end of that sale, they should be handed to their tax professional. Even if they fall under this home sale exclusion, they should be giving that to the tax professional if they're following the law and the rule, okay? Because obviously title, all of them, they send this information in, right? The county send this information in when a home sells. They know. So you have to make sure. A good rule of thumb also, if you have sellers, is every December on our team we do this, but we'll reach out and say, hey, do you still have this document? Do you need it, right? Because we keep it for compliance when we close on every sale. At least I do in California and Florida. So our sellers, I'll reach out and say, hey, did you lose it? Do you still need it? Same thing applies obviously with my tax clients and my firm, but this is a practice that we do. And as agents, keeping that document can really help your sellers, especially if they were in a different situation. All right. Now, you're like, Cameron, and there's a lot more of these this year, but what about short sales, loan forgiveness? I may have been a part of that one before, so I definitely even have a personal story in that one. Or foreclosures. Okay. Look, here's the reality. Let's say $100,000 on a mortgage. For whatever reason, it gets forgiven. Whether that's $100,000 in equity from a short sale, or there's a lawsuit against a bank and your client 1 does not matter. Foreclosures fall under a different set of rules. It depends what type of foreclosure. I'm not jumping into that. I'm not an attorney. But when it comes to short sales, loan forgiveness, like that bank will give a 1099, like your client made income, to the IRS. Now, if it was their primary residence, there is a rule. This in 2025, this is the last time, unless it gets extended, that this is going to exist. But there is an exclusion that in those situations where that 1099 is given, right? There's a short sale, the loan is forgiven for a lawsuit or whatever reason. That bank will extend a 1099 to the IRS, and it could skyrocket. Imagine if your client normally makes like $50,000 a year, and now all of a sudden it looks like they made $150,000. When let's be honest, they didn't get the cash, right? That's a tricky situation, but I do this every day, so it doesn't really freak me out. I've been in this situation personally as well. As long as it was a primary residence and they have records showing that they were living in the home and everything, they have it all ready in case they get audited. Because let's be honest, you always want to do everything like assuming you're getting audited, even if you don't. You want to make sure that you do it right, and you're able to give that 1099, and they're able to exclude that income. So there is that rule in place. Unless they extend it, 2025 is the last year. They are allowed for their primary residence to not have that count against them up to a certain limit. So for most around the U.S., this is going to apply. But it's a good conversation to have with your source. If you have a short sale, or foreclosure, loan forgiveness, things like that, you want to make sure you have this conversation so they understand they should talk to a tax professional before they close, before they get thrown into that meat grinder. Okay? Now, energy efficiency and clean energy credits. These float around. Some states will have their own version of a credit. It is something to look into. A lot of people don't always get the best benefit from it. To be fair, a lot of times, you may only get credits for this if you're itemizing deductions. Most of our clients, because most of us work with regular W-2 employees, most are not itemizing their deductions. They're doing a standard deduction, so the flat rate, whether single, married, jointly, head of household, whatever the IRS gives for depending on the filing status of your clients. Most are probably not going to be able to tap into this. But if you have clients that do make good money, or they had a really expensive year between just all life expenses that the IRS allows you to deduct, then this could be a door that opens. So I know a lot of clients bring this up anyways. So it's very good to look into your state and local area, or you can reach out to me and we kind of talk about what energy credits, home improvement credits. Like, it varies by state. The federal government does have certain things in place. It changes by the year. Sometimes, midway through the year, things will change. The reality is, make sure you look into it. It's client specific. But when your clients bring it up, say, you know what, it's definitely something you need to look into. I think as agents, depending on your local area, you should be understanding of what you're looking at. But when it comes to those credits, again, if they're not itemizing and they're just kind of making bare bones income, most of the time the standard deduction is going to be higher, even if they're allowed to take these credits for whatever they spent. Right? All right. Next, obviously, mortgage interest. Obviously, this is pretty standard. Everyone who has all your clients and yourself included, if you owned a home, obviously, if it's your primary residence, like, you get the mortgage interest. You paid it every year. That's pretty common. Usually you don't have to bring this up to clients because the bank sends it to them every single year. It's really rare for someone to not provide that when they go to do their taxes. But obviously, again, be the professional, be the connector. Bring it up. Let them know, hey, your mortgage interest, you'll get a form from your bank, by March of every year. It's good to be able to throw that in the pot. All right. Now, it's only for interest on mortgages up to $750,000. Okay. Again, also, it can be after, obviously, it's only up to $750,000. All right. If the loan was originated after December 15th, 2017, it is deducted when the taxpayer itemizes deductions. Okay. So the reality is, and I'm not trying to get into the weeds. If you really want to know the difference between standard and itemized, I might actually, you know what? I'm going to do that. Let me know. You can send me an email. And it's always in the show notes. If you really want to know the difference between standard and itemized, which is pretty basic, I think I'm going to do a newsletter week on that to really show the difference and when it makes sense. Because I think a lot of people do not understand, especially agents. So I'll dive into that. So if you're itemizing deductions, mortgage interest up to $750,000 mortgage, you can make it happen. All right. Now, This is a big one for those that work with investors. So depreciation for investment properties. Now, you have to be an investor. Now, who is a qualified investor? Okay, here's who qualifies. All right. Individual landlords who personally own a house, condo, duplex, or ADU they rent out. Accidental landlords, those that move out and keep their home as a rental. Short-term rental hosts, LLCs, and partnerships holding rentals or investment properties. Okay. Now, for LLCs and partnerships, the key intent is it's rented or available for rent to earn income. Okay, for them to qualify. Now, most of the time, this isn't always beneficial just because you own a rental property. Obviously, a lot of people like to throw the term out there of real estate professional. Okay, if you're a client or yourself, if you've got rental properties, if you're not doing 750 hours or more a year in real estate, specifically working on rentals in your properties, you technically don't qualify, and most likely you may not be able to depreciate any of your investment properties. Okay, it doesn't mean you can't write off costs from them. All right, totally different. We're talking about depreciating the asset. All right, and typically it's not for the land value, it's only for the home value, and you spread it out over like 27 and a half years, or commercial properties are 39 years, that you spread out the depreciation value. Obviously, calculations, it depends on your property, running calculations on that. But for residential, if you do have the ability to depreciate, you're taking the value of just the home, not the land. You depreciate it over 27 and a half years. So every year, you're allowed to deduct that depreciated a portion of that depreciated value to lower your tax basis. Again, if you're not a real estate professional, this really doesn't open up. I know it says, you're like, oh, investor, I qualify because it says that these are the basic criteria. But really, the reality is, if you're not working 750 hours or more, the IRS gets very, very picky, and the qualifications are not going to open that for you. All right? Again, only the building, not the land. Okay? It's an amazing tool, right? You see it on social media all the time. A lot of agents talk about it. Okay? The reality is, you got to be a real estate professional. Okay? And as agents, obviously, we're working a lot of hours in real estate. So there can be a case for you to fall under that hour rule. But for your clients, understand that if they're not a real estate professional working that long hours per year in the business and it's only a part-time gig for them, great chance they're not going to be able to take this depreciation to help them out. Okay? Doesn't mean they'll never be able to, but the reality is there's stricter criteria when it comes to really getting the maximum tax benefit in your rentals. Doesn't mean you can't depreciate repairs, expenses, things like that. Totally different. Obviously, they should have it under an LLC if it's strictly for investment properties. Whole different ball game. They just might not be able to use all the tactics that the IRS allows for investment property owners until they hit a certain level. Okay? Now, the next thing when it comes to investors, outside depreciated value, again, most of your clients are not going to take it unless you're working with heavy investors. And to be honest with you, if you're working with seasoned investors, they probably already know this. But the next one is going to be 1031 exchanges. Okay, now I've dealt with 1031 exchanges. Now, you are not expected to be the expert on 1031 exchanges. I really recommend you look them up yourselves. I'm not, like, I can go pretty deep onto, because there's reverse 1031s, there's the 1031 exchange. There are different types of 1031 exchanges, okay? I'm doing the one that most have heard or utilized, which is when you sell a rental property, there's capital gains tax, right? You're losing a substantial portion of your value. You are telling the IRS, I'm going to buy something of equal or greater value or type to the property I'm selling. So instead of giving 20, 30+% to the IRS off of what they gained on the sale, they're taking all that income, using an intermediary, right? So there's 1031 exchange companies. Do your research, find one you like. Especially if you got other agents that have used one in your local area, stick with them. That company works as an intermediary, right? So when the sale closes, there is a time limit for that investor to take that money and to buy another equal or greater value rental property, right? It has to be at least equal to the property they're selling or greater. And that's how, obviously, a lot of investors, like I said, you don't make a lot of cash flow, especially in today's market, on most properties. It's doing things like this where you really start to accelerate the growth with your rental properties, okay? So And like I said, there's different types of 1031 exchanges. That's the cool part. Like, doesn't mean you get to use all of them. I highly recommend you dive into the world of it, because there is, look, I'm not trying to get into a huge ball game in this dive in of the 1031 exchange. You always want to use a 1031 exchange company, right? They're an intermediary. So when that client sells that house, this company is holding the money, taking care of all the legal checkbox to make sure they qualify, and landing it on the backside. But you're obviously, your client or you is going to need a tax professional as well on both sides, okay? It's a whole ball game. You got you, the agent, making sure they hit the timeline, because they got a strict timeline, right? Do your research. I'm not trying to dive deep into them, but there is a timeline for them to buy that replacement property or at least be under contract. So, gotta be strict with it. 1031 exchanges, I have really gotten good with investors. The fact that I do understand it, and I've been lucky enough since I got started in the business that I have understood 1031 exchanges, and I have facilitated as an agent several. So I've been lucky enough to be a part of them, seeing some issues and pitfalls. Make sure if you have someone in your local office, you stick with them. On the tax side, you mainly just want to make sure your client has a tax professional who can walk them through what their tax base is going to be. Again, if they're deferring it, that's okay. That's great. Just make sure that you're staying on top of it as the agent to understand there are timelines involved. And I'll be honest with you, the investor tax benefits here are probably the biggest thing as agents that you need to understand. I cannot stress to it more, because like, look, you got 45 days, okay, to identify the new property in writing. You have 180 days to close on that property. Like I said, those deadlines are strict, not flexible. So your client, if you go to do this and you're the agent on this, I think you're going to be pulling a lot more weight than you may be used to with a normal client to make sure it happens, right? To be fair, especially with this commission-changing world, I think it is totally fair to charge more commission if you know how to do this well, to make sure that you're running the ground game for that client, right? You are running that game. Especially if you have a good 1031 exchange company you can recommend to them, you have a good tax professional, you are light years ahead of most agents, especially when it comes to working with investors. Because they're not just buying one home and being done for the next 30 years. They are trying to buy as many properties they can get their hands on, all right? Now, the next one is going to be property tax and SALT deduction. Now, again, when most use the standard deduction, a lot of these don't apply, okay? You're telling the IRS, instead of itemizing and breaking down what deductions you get, and that, like, there's credits, right? Credits are different than deductions, and that's not what I'm talking about right now. But in terms of the deductions, if your clients are taking standard deductions, a lot of these don't apply. But for all of us out there, we want to get to wealthier clients because, you know, bigger commissions, and generally they tend to be better clients sometimes. There's a limit. Trust me, there's a limit to expensive clients can be very needy. But, you know, there is a point where you start working, like, for example, even recently in San Diego, you know, we were working with one of the board members of NVIDIA, okay, to find a rental property for him to utilize in San Diego, okay? That's a client he's itemizing his deductions. He is a high income earner. He's trying to buy rental properties to cut his taxes, right? Another thing, a great example, sometimes when you go to work with investors as well, you always want to ask, are they trying to shoot for cash flow or are they trying to get tax deductions, okay? Because that very much changes your recommendation as an agent for what they're trying to get their hands into. Now, back to property tax and SALT deductions. What is it? SALT stands for state and local taxes, okay? So mainly for most homeowners, that tends to be the property taxes that they pay. Again, depends on the client. It can change wildly, but it essentially stands for state and local taxes and it's a deduction for Fed taxes. Now, it can be more than just property taxes. It can be income tax, local sales tax, okay? But deductible only if the taxpayer itemizes, right? So instead of taking like a flat, like a $15,900 single person deduction without itemizing, they're saying, hey, IRS, I don't want your standard deduction. I need to break down all the costs I have that you allow me to deduct. And generally, you only do this if the deductions are going to be higher than what the standard initially was, assuming they're legal deductions, okay? Now, for 2018 to 2024, you were capped at a deduction of $10,000. So between all those things I just mentioned, with proper proof and paperwork, you could deduct $10,000 max. Now, big change in 2025 with the one big beautiful bill, okay? And this is especially for those of you who are working with luxury clients and you want to seem a little like you're in the know, even if you're maybe not making that much yet. All right. Now, beginning in this tax year, 2025, right? So this end of year into January, when we start doing your taxes, that's for 2025. The 10K limit is temporarily raised to 40,000 for most filers, not everyone, until 2029. Okay. Now that 40,000 will increase by 1% per year from next tax year, not this one, but next year, 26 to 29. But for taxpayers who have a modified income, which is just a fancy calculation, I'm not going to dive into it because I don't have a tax form in front of me to show you guys. All right, I'm not going to dive into it. But for taxpayers that have an adjusted gross income over 500,000 per year, the deduction phases down, right? Now, it doesn't go lower than 10,000, but understand if you have clients that are making over 500,000 a year, then there is a limit for them to go down. Now, you're like, Cameron, why are you going into this right now? This is not just real estate taxes. I understand. But remember, not just because a client makes a lot of money doesn't always mean they know how to spend it. Hell, I've seen luxury agents. I'll never forget when I ran my notary business, I had 2 luxury agents, and they were going bankrupt because they just bought too much crap, right? It happens. So just because your client's making good money does not mean they understand this stuff, right? I feel like in today's world, as agents, the more you can understand, even at a basic level, on all the areas our clients are affected in real estate, which is mainly real estate itself, taxes, local laws, ordinances, things like that, the more you're going to stand out for these clients. And I firmly believe that. Okay? Now, after 2029, it reverts to $10,000 unless Congress changes it. But understand, for your wealthier clients, there's a limit. All right? So for your clients that maybe got a new job, they're starting to make good money, bringing it up to them that, hey, there is a limit where TurboTax just ain't going to work for you. Now, for most W-2 filers, yeah, fine, TurboTax, go for it, unless you want someone like me to do it for you. And don't forget, for agents as well, this also applies to you, okay? So if you have those fees, again, you have to make sure you have everything tracked and itemized in receipts, but you can up to 40,000. Now, if you're making over 500 grand, like I said, it phases down over that, not to go below 10,000. But this is probably a huge deduction if you do it right. Unfortunately, there were a lot of things when that changed in June that if you didn't do certain things, depending what deduction you're trying to add into, or sorry, what reduction you're trying to add into this SALT deduction, you're not going to be able to do anymore because it's already done for the year. But keep in mind, this is a big one, especially with even you as agents when you do taxes. And for clients that maybe you got some clients that have been with you a long time and they're starting to make some good money, make sure they understand once you hit a certain threshold, the standard deduction is just not enough. If you really want to save and only pay your fair share to Uncle Sam, you really need to make sure that you look into deductions and things like this. So agents really understanding this. And like I said, there's so many. You could take any one of these. The newsletter's online, links always below, and just type it in for dummies. Or ChatGPT, right? Like you can get a general overview. And then for niche situations, when it comes to like your personal situation or a client, so you can always have them reach out to someone like me and my team. And then we can actually dive in using our software and laws and knowledge and be able to like, all right, look, here's what you can actually do. Here's an estimated, assumption of what you're going to owe at the end of the year. Okay. Now, moving on to the next one, retirement and HSA contributions. I don't know. Agents, I know we're bad with money. All right. We are bad with money, on average. This one is generally just retirement and HSA contributions, right? So if you have a high deductible insurance plan, you can open an HSA account, which essentially is just a high interest savings account used for medical expenses. Not only should you as agents be doing this, and I have other podcasts and posts talking about this, I think it is good for agents to want to be financially minded, okay? Making sure your clients understand, like, why not? Like, you should be sending updates, and you want a reason to talk to your past clients as much as possible. Why not? Like, you could partner with a tax professional in your area or just in general. And why don't you give away free tax consultation and advisory sessions, right? They usually only take an hour, and you can give this away. But making sure your clients, like just sending out a reminder, like, hey, have you maxed out your IRA, your 401k? Like, is there anything you have with real estate related that maybe we could put that money elsewhere? Like how, this, that, all that, okay? You really want to make sure as agents that you understand the basics of it. There's obviously, IRAs, 401ks. You're not trying to be a tax professional here. But this also affects you as agents, right? Like you should eventually, when you have an S corp, like it would make sense to have a solo 401k. Why should you give more money to Uncle Sam than Uncle Sam needs? Okay, all of us started in real estate, I think, to have a better life, to be on our own and support our family. So you really got to look into that. And having clients and pushing them and reminding them, like, hey, have you maxed out your retirement? Are there any, do you need a professional to talk to? Like, you want to be the connector for all things. And that's how I think agents should be. All right. Now, moving on faster as we go through things. All right. We're going to wrap this up here. So, 8, keeping closing and renovation records, right? Buy or sell a home, keep that closing records. You as an agent, you should reach out to your clients before at the end of the year and be like, hey, do you still have it? Do you need it? Okay. Be the practitioner trying to help them. It's going to go miles down the road, right? Mileage, work-related travels, especially for you agents. If you're trying to take a mileage deduction, make sure you're using like an app or whatever to make sure you track it, okay? Not so much helping your clients, but if you're able to do it yourself and use it well, why not share it with your clients? I know you're going to have some that are 1099, okay? Which means you're self-independent, self-employed, all right? Now, that sums up everything. Let me leave you with this. As agents, you're not trying to be the tax professional, not trying to be the attorney. But I really think in today's day and age, the more that you can understand the basics of all the real estate taxes, especially your local ones, not only do you help your own personal situation and understanding, but you start to be able to guide your clients, right? What plan is best for them? How can you help them? Do you know a professional that you can connect them with, right? For example, if you don't have a professional, again, you can always reach out to my team. You head over to superdadtax.com. Again, superdadtax.com. You can reach out to me at Cameron@superdadtax.com. We can set up a consultation if you need it for yourself. If you got a client who needs help, hey, you can always do it. You always connect them to me, and I can help you look like the superstar that you're meant to be. All right? But use this guide, use this insight. I simply want it to be the opening door for what you're trying to do. So that way you can help your clients more and look more like the superstar and actually be knowledgeable about how this business works. We live in a great country, everyone. But unfortunately, things are more complicated than they were 200 years ago. So you have to make sure you have the professionals you trust, you like, and that you have a general understanding yourself so that way you can help your clients make the best decisions for them. All right, that wraps up this week, everyone. Take care. I'll see you next time.